Hey everybody, welcome back to Tax Tuesday. We're live on YouTube. Welcome back. We're officially at the kind of the 2-minute warning of 2025, guys. So less than 30 days, less than the year. We're live here talking about your tax questions. So welcome back everyone to Tax Tuesday.
Great to have you.
My name is Barley Bowler, CPA, tax advisor here at Anderson. Great to have you all back in the chat. As you all know, this is kind of for everyone on YouTube, right? So if you haven't, we're going to go through kind of some of our services, but this is open on YouTube, answering your tax questions, bringing tax knowledge to the masses every other Tuesday. So here we are.
And I'm Elliot Thomas, manager of tax advisors, and just so thankful we have you here.
So for anyone here for their first time, big welcome to you. Welcome from all of us here at Anderson Business Advisors. Again, every other Tuesday we do this Tax Tuesday live webinar answering your tax questions. Submit your questions. Here's the email address, Tax Tuesdays at Anderson Advisors. We go over your questions, kind of sort them out, go over them live, and try to have some fun doing it, bring you some knowledge in the meantime. This is meant to expose you to kind of a myriad of different concepts. And we'll go in the weeds sometimes too, right? We'll dig a little bit as well. But we got a Q&A feature in the Zoom. Post any questions that you have. Also got a live chat in there if you got any questions about the service or the presentation or anything, if you have any audio or video trouble there.
And Troy handling the chat today.
Oh, we do?
And,
good.
Yeah, we got Patty out on the road today, so Troy's taking over. And
thank you, Troy. Most of you guys met and know Troy, Mr. Troy Butler. Yeah, so submit questions as we go, right? We're going to answer your questions live as we go as well. Of course, if you're one of our clients here, you can submit questions anytime you want to the Platinum Portal. Plus, we have a live, ongoing Zoom meeting 5 days a week, 5 hours a day. You can come in there and ask questions as well. So we'll go over the service as well. If you guys want to become tax clients, we'll certainly provide that option today. Fast, fun, and educational.
Yeah, and Troy's saying he's the best.
Yeah. And, I'm sorry, I hadn't mentioned that yet. Troy's the best. He really is.
He's prettier than Patty with the beard. So we'll take that. And in the background answering questions, we got Dutch, Jared, Jeffrey, Rachel, and we always said Troy. But they'll answer all your questions that you throw in there. Usually get about over 100 on one of these sessions, so we're so thankful to have their efforts.
Yeah, we got some heavy tax hitters in the background, guys, so hit them up with your questions, and we'll certainly, anytime you guys have a question related to the topic here, we'll certainly try to pull that up live as well. Yeah, let's hop right in. We're going to go kind of run through the questions real quick here just to give you an idea of what we're going to be going into, and then hop right in. Anything you want to announce before we get started?
We got the live event that's coming up this weekend down in Dallas.
This weekend.
Thursday, Friday, Saturday.
It's already December.
Weekend. Yeah. So
that's amazing.
So that'll be, if you're near Dallas, come in. It's a live event. I'm sure we have some promo in our slide deck here today.
I'm sure we'll be talking about it at some point in time. Absolutely. Yeah, so live event this weekend. Yeah, we will be kind of giving you more information on the live and virtual events, more upcoming, lots of events upcoming. Just trying to get you guys this information, tell you about these services, and let's hop right in.
Let's do it.
All right, we're going to go through the questions here. What are research and development costs? For some of you, that may actually be an issue. Maybe not for a lot of us, but for some of us, that R&D costs, kind of some new rules there. How are they deducted? Great question.
What expenses that I incur on behalf of my employer can I deduct on my personal 1040 tax return?
Can you please explain what a 72T procedure is? Hopefully Elliot can.
Yeah. I am considering investing in an opportunity zone fund to defer capital gains. What are some top items that I should be thinking about?
Good. How can I be tax exempt from paying the IRS the penalty of using my retirement money to buy a condo? More real estate questions, great.
Are expenses such as real estate property taxes and home improvements deductible on vacation homes that are used both for personal and rental purposes?
Yep, another very common question. I'm attempting to calculate the reimbursements for our administrative office. How do I calculate how much can I reimburse myself for tax-free every year? We're going to go into that as well.
And there we have it.
As usual, there we have it. That's the question. We'll get to the answers though. As usual, guys, make sure you sign up for the YouTube pages here. Are we subscribed? Yeah, we are. Toby, Clint. Toby focusing on the tax law, Clint on the asset protection. Tons of great interviews, as you guys know. Check out the YouTube channels there.
He was just cutting another video or two today.
Oh, yeah, right. Yeah, I don't know how up to date this is, but yeah, so much new content coming out all the time, and over 1,000 videos, over 1,100 videos. Lots of content on there, guys, all free, right? This is all trying to just get this information to you guys on YouTube. It takes a lot of work to get through all this. It isn't like you just hear it once and you got the answer. So we want to try and get this to you guys in as many different ways as we can. And the upcoming event, here's the QR code as promised. Do you scan QR codes?
I do.
Okay, good. Because I tried the other, I was like, you just take a picture of it, right? And I was like, no, you have to have the QR code scanner. I forgot all about that.
I do both. Yeah.
Okay.
I've done that.
So for those who know how to scan the QR code or visit the website, we got more information there. Lots of ways to get in touch with us on more information on that event. What's this?
#1 real estate protection workshop in the nation.
What?
Pretty bold, but it's
Man.
true. We stand up to it.
Tell them all about it.
Yeah, we got, again, the live event here in Dallas coming up Thursday, Friday, Saturday. Please attend if you're anywhere near. It's a great event, chance to meet some of your other like-minded investors and things of that nature. Of course, we're covering a lot of tax, asset protection, all that good stuff. And then we have the virtual Saturday, December 6th as well going on, and then the following weekend, December 13th on Saturday.
Yep, and for anyone that hasn't been to one of these live events, they are a lot of fun. Meet your fellow entrepreneurs, network, you get a lot of good synergy there, a lot of good, just kind of those conversations lead places, right? We form those networks and build them out. Excuse me.
Absolutely.
And if you want to, you can scan this QR code right now and set up a strategy session with us right now. Are you interested in becoming a client? You want tax planning, tax guidance? Maybe you have someone doing your tax preparation, but maybe you don't have a CPA you're comfortable with guiding you through this whole tax maze, right? This is where we want to do strategy sessions, tax planning, tax consulting. Scan that code and get more information right now. You can set up a call right now. So.
It's a good point you make. I think that's the #1 thing I hear from clients is I'm not hearing anything about why my taxes are the way they are, not getting any insight on planning or anything of that nature. Well, we have a whole staff, Barley being one of them, tax advisors, to handle just that.
Yeah, it's such a good point. To no fault of your guys' own, I'm sure in your mind it's like tax is tax, right? It means preparation, filing, advising, all this, paying, all this stuff, right? In our world, those are kind of very different silos. Of course, they're all kind of the one engine driving this whole tax machine. But yeah, a lot of different components there. Any questions you guys have, please let us know. That's why we're here today. So,
all right, let's do it.
Oh, we're starting with a kind of a different one.
It is. We talked about it not too long ago on one of our tax wises.
Yep.
Right after
we had changes in the recent legislation.
Yes,
talked about that.
But what are research and development costs, and how are they deducted? Really kind of a niche area.
Yeah.
But it is talking about developing products, anything related to that, or especially software. And we have clients that have been in both those avenues. So you're really looking at the expenses related to actual development of that product. Now, it's a fine line. It's easy to get into the areas where maybe they aren't costs related to that, such as maybe building a building where you do all this isn't related, but anything related to making a product. We've had clients make accessories for vehicles and things of that nature. We certainly have a lot of you out there software development in the software development field. All those costs related to that, typically you can deduct right away with the new rule.
Right.
This is all as of July 4th. Prior to that, you had to amortize over many, many
15 years.
Exactly.
A long time.
Exactly right. And there are some other nuances behind it too. But as of July 4th, when the new bill came in, as long as it's domestic, that is, you're doing it here, the costs are in the U.S., you have a choice. You can go ahead and deduct immediately 100% of those related costs for R&D purposes, or you can make an election to go ahead and amortize over 5 years. Now, we were hypothesizing, why would anybody want to do that? My gosh, I can take all that deduction right now. Why would I choose 5 years? It was we thought about it, and just kind of stared at each other for a while. But what if you had, say, $500,000 of R&D costs, and maybe you have only $200,000 of income that you expect this year and the future years? Probably be better over time to just take $100,000 each year as opposed to $500,000 in the first year. Yeah, you didn't pay any tax the first year if you wiped it all out, but what about taking $100,000 each year? And we talk about that in many other avenues as well. If you've heard a lot of shows where we talk about spacing that expense out there, that's one thing that's really nice with this again is if you have domestic related R&D costs, right here in the U.S., then you have an option. So whatever fits you, it works really well for a lot of our clients as a tax planning item. However, we also do have a lot that work with international development on certain items. There we're still under a 15-year amortization. That means if you incur $500,000, divide it by 15, that's how much you're going to deduct each year for the next 15 years. Not nearly as favorable. Clearly, it's one of those things to try and bring high tech, any kind of research type element back on stateside, and that's kind of what's driving it. As we always often talk about, you hear Toby talk about this all the time, Barley brings it up, a lot of our tax code is driven, it's here to drive us. That is the word right there, exactly.
Right, that domestic portion that encourages us for domestic investment, domestic research and development. What point did I want to cover on there? Oh, exactly, the spreading it out over 5 years. We're trying to eliminate those high bracket tax dollars. We don't need to eliminate our first $10,000, $12,000 of income. It's not even taxed. It's at 0%, right? Me, you, and Warren Buffett all pay the same on our first chunk of income, effectively zero. It's expensive to eliminate 0% tax dollars. What's the point? We're gonna try to offset those higher tax dollars and spread that benefit over time. Exactly, great point. Kind of time value of money plus just good classic tax planning. So what kind of costs can we deduct here?
That is what we run into where it gets a little bit gray. You're going to be, again, you're going to hear the same thing over and over. It's going to be labor costs, but they're directly related to that product development, that software development. Of course, any material supplies used, any machinery used in there, you can certainly depreciate. We talk about bonus depreciation. We got that, or 179. You can see where some of these other aspects of the code start coming in. Nonetheless, this is R&D. Now, we have to be careful though, because if it's again the building or something like that, that's not allowed. That's still going to be under 39 years because it's a commercial building. You're looking at the straight line depreciation. Could still do a cost segregation, bonus depreciation perhaps on that, but it's not going to be your immediate R&D deduction. Certain related overhead costs that are directly related, the rent, supplies again like we've talked about, repairs, maintenance, anything like that directly related to the product itself. Travel costs even related again directly to the R&D if you can have that kind of pathway of good documentation showing that travel is related directly to the R&D. Talk about that all the time. It's really not, we're not asking a whole lot more than we would for any other deduction. Just good documentation, great bookkeeping. We always talk about that. Kind of the same thing, but we just don't get to talk about R&D too much. There was that big change with the new bill, and so that's why we're hitting it today. And again,
product, app, software app, like Elliot mentioned, those are going to be common things. For you cost accountants out there, you might be thinking like direct versus variable expenses. Those are kind of avenues we'll go down there to figure out what kind of costs we allocate actually to this product, and that they're deducted different ways. But
and then for just a real quick overlook at what's not included, it's going to be more your general, oversight costs related to could be. Indirect support, payroll, things like that, costs related to that type of thing. Think things that are just kind of outside of the direct impact on that product or software.
One of the ones we talked about earlier, that quality control function, that's kind of a confusing one, but if you think about it in a way, that wouldn't be the development of the product. Once the product's developed and we're putting out product, we need to test for quality control. That's why that isn't included in there. That's another kind of confusing one. And again, this is going to apply to a certain specific kind of range of you guys. If you have specific questions on this, please let us know. We can certainly go into more detail on this. But this is part of the new bill. It's great legislation encouraging us to invest dollars in manufacturing. We're going to talk about qualified opportunity zone here in a little bit as well. Similar kind of concept there.
Yeah, we'll start building. It's one of those things, one thing that we did exclude, we're just trying to look at the examples. We have a lot of real estate investors. Probably you went out there with your 2x4 and tried to learn different ways to get 3 nails or 2 nails instead of when 3 is really required. That's not the R&D. That's
it's not R&D.
Probably not what they're looking for here. It is going to be, it doesn't have to necessarily be techie, but it's going to be more product driven or software development, things of that nature.
Yeah. Great.
I think we got that one.
Yeah. Any questions on that, let us know. Again, if you have a specific product or service that you're developing, that could very well be a good option for you. Let us know if you have any questions on that. All right, any questions we want to hit in the chat there?
I think they got it. They're on top
All
of
right.
it. No surprise.
All right, moving on then. What expenses that I incur on behalf of my employer can I deduct on my personal 1040 tax return? What was that thing we used to have? miscellaneous, 2%,
Something
itemized
like that.
deductions.
Somebody remembers.
Pre-Tax Cut and Jobs Act, right? We did have a way we could deduct, well,
2016.
right?
Yeah.
A small well, what is it? Whatever exceeded 2% of your AGI or whatever. So we had that previously. We don't have many options here.
We really don't
anymore.
Yeah, and so that's kind of why I picked this, because I do get this question surprisingly, quite a bit. And, you're incurring your own expenses on behalf of your regular W-2 job, on behalf of your employer, who is an unrelated party. You really don't have an avenue to deduct those. Hopefully they'll reimburse you. That's the best you can do, which we'll talk about that a little bit later on. That's certainly something.
That's your number one.
Yeah, but if they choose not to reimburse, they're not forced to usually. And so you really don't. Since the Tax Cut and Jobs Act, and again, even under the July 4th tax bill, it continues to be that we have to itemize first, back when we did do this, and then it had to be in excess of 2% of your adjusted gross income.
Yep.
So if your AGI was $100,000, you had to incur at least $2,000 of these expenses before you could deduct the first dollar.
Right.
So it wasn't all that favorable to begin with, but that's even gone, anything like that. Now, we learned in our research that there are 4 exceptions to this, that people have certain expenses related to this that they can deduct.
And the first one's pretty obvious. You probably might have even have assumed that, right? If you're, there's a term in here, reservist.
Yes, yeah.
That kind of, so not all armed forces, but armed forces reservists can be reimbursed for certain, I think it's moving expenses and stuff, right?
Exactly. If you have to do some kind of travel related to your reservist position, outside of 100 miles, then you can go ahead and reimburse those expenses. So we're glad to see that we have that available for those serving the country. Qualified performing artists, that's a kind of a tough one. While it is allowed, it's very restricted. Some of the detail there.
We could throw starving artists in here potentially. You'll know we have a what we're talking about is for qualified performing artists, whether they can deduct these unreimbursed expenses. Well, yeah, you can if your AGI is below a staggeringly low $16,000. So, if you're effectively close to the poverty line or so, you can deduct that. Hopefully that's not the case for you guys, but if you've got a crazy uncle or cousin or something in the house that's a juggler, and maybe this will be for them. Of course, we just want to throw these things
They're
out.
all ears right now, I'm
for
sure.
You're
listening on this one.
You get the knife juggling act going again.
Exactly.
Yeah, but it's primarily for reservists. What else? There's this for local and government officials. I don't even know what this really means, to tell you the truth. There's for fee basis government officials.
As best we could determine from that is where you are an employee of the government. However, you're only paid on a specific fee for a service you perform. It's not the same as an independent contractor. It is distinguished from that. I've never met anybody who's paid that way, but that is one of the exceptions. And the last one, a very understandable one. Employees with impairment-related work expenses. So if you have any expenses, if you're impaired, and expenses related to that job, you can go ahead and take deductions for that.
Yep. And again, if you can get reimbursed by your employer, that's option number one, right? But if not, then we do have some options on that. Would you throw that $300 educator thing in there? Would that kind of be in this category?
I think it's certainly worth mentioning. That's if you're an educator, you can get that special deduction.
Out of pocket up to, I think it was it might have gone up more than that, but I think it's still $300. But.
Yeah, it's not. I can see. I don't know why it wouldn't be on this list, but it wasn't one that came up.
Same kind of concept.
Yeah.
You can if you're a teacher or educator. I think it even includes coaching potentially. A lot of times you guys are coming out of pocket for a lot of those supplies, just throwing it out there. Any questions, let us know.
I know we got a lot of great teachers here that I personally know here in the Valley that do that, pay for a lot on behalf of their students, and so we're very thankful for that.
All right, moving on?
Yes.
All right. What's this one?
Right. Could you please explain what a 72T procedure is? I don't know, but it sounds scary. But
sounds like a tax-related thing.
It is, and they're probably talking about something to do with 72.
Section 72. We dig in there a lot. Yep. Yeah. So what we're talking about here? I almost said how to Rotherize your IRA. How to Rotherize your traditional IRA. What we're talking about is a few terms here: required minimum distributions, age of retirement. And we're looking at our IRA and potentially turning it into kind of an annuity and setting it up in a way potentially where we can avoid the penalty is kind of the whole goal here. So what's the background on this?
Yeah, so let's say you're 30 and something's come up and you need money that's been put away into an IRA. We are talking IRA here, or IRA related. That means SEP
As
IRA.
opposed to a 401k,
Exactly.
right? Individual retirement arrangement IRA. Yeah.
Or any of the IRA based, like again, a SEP IRA or something like that. But not your 401k, as Barley points out, exactly right. But let's say you're 30 and you need that money earlier for whatever reason. You can put up an arrangement, if you will, where you take equal amounts, just like an RMD almost, equal amounts each year until there's a couple different ways of defining this, the amount, but basically over the term of your expected life. And so you can start getting these amounts and you're not subject to the 10% penalty. Now you are taken out from an IRA, so we're still going to pay tax on that.
Right,
we're not.
You got a tax break going in.
Exactly. So we're not getting anything like that as far as getting away with the taxes on it, but we're not paying that penalty. And for those who might really need this, maybe they've been in some kind of injury or something like that, they have some kind of medical condition, whatever it be, you can go ahead well ahead of time. You don't have to be 59 and a half or in retirement area ages, and you can go ahead and start taking from your IRA. Again, 3 different basic ways of doing it. You can calculate it on the same way you would an RMD, which is based on your life expectancy. Well, always they're paying for
required
that.
minimum distribution, just in case anyone unfamiliar there.
And that is adjusted each year. So that amount you take out it looks at what's in the plan, and then they divide again by whatever your expected life is. So that can change from year to year.
Sounds like some actuarial formulas.
Exactly. Yeah, you're definitely talking someone who's smarter with numbers than I. But then you can have also these straight line payments where you've again determined what your expected age is, and you just take the same amount each year. You noted a really interesting little switch that you can make in between this process. If you start on where you take the even amounts of payments over time, you can make a switch to the RMD method, which can fluctuate a little bit over years. But
right, it allows for one-time switch.
You get the one time that you'd found that exception to it. So it's a unique thing. We've only get asked this a couple times. That's why I picked it up, because last time I was asked was probably 7 years ago. I don't know. It's been a long time since this has come up again, but great to see it back out there. Every now and then someone asks about the 72T, so it is a real thing. It's a way, it is only for IRAs, and it's a way to get that money out earlier if we need it.
Right. Normally you have to wait till age of retirement to start pulling from the IRA. This just kind of takes that one lump sum and makes it even distributed payments from now through the rest of your life. It just avoids that penalty. But
10% penalty. Exactly.
Yep, exactly. Good.
So there we go.
Yeah, anything else on that? No, I don't think so. Good question. All right, what's next? I'm considering investing in an opportunity zone fund to defer capital gains. You guys have likely heard that term, right? Qualified opportunity zones, economically distressed areas. The government is, again, incentivizing us to invest our dollars into these economically distressed areas. Or, I hesitate to say economically distressed. There's some areas they just want to encourage investment.
Correct.
They don't have to necessarily be economically distressed areas. Certain rural areas are going to be perfect for large-scale manufacturing.
Yes.
And so they want to encourage that, open space, more resources, et cetera. Anyway, back to the question. Looking at an opportunity zone fund to defer capital gains, that's what it's for, right? If you're sitting on a big chunk of capital gains right now, one of the things you'll want to consider potentially is a qualified opportunity zone, and using a fund to defer or eliminate those gains. We'll talk about that detail here in a minute. But what are some top items should I be thinking about?
Well, one thing that often people ask us is, well, should I create my own fund?
I don't like doing things
Do it yourself kind of thing? No?
Yeah.
Or should I go to some big investment firm that's doing it?
That sounds expensive.
Yeah, but
got to find a sweet spot in there somewhere,
yeah,
right?
well, there isn't one. It's one or the other. You're going to have to either do it yourself, or you're going to have to find a group out there that's investing a lot of money. Sometimes it's nice just to tag along with the big folks like that who are investing in those.
Like a syndication kind of thing.
Right. But it is a fund. And what is a fund? It's either a corporation or a partnership. Now, that could be an S corporation or a C corporation. A lot of time we see real estate development, and if you ever heard anything, learned anything from us, we never put appreciable real estate into a corporation.
Rarely.
So we're going to argue that you want a partnership if it's real estate. Now you can invest in actual businesses as well. It doesn't have to be real estate. If you're doing that, well then maybe the S Corp, C Corp are better options in that case. Nonetheless, That's your fund, and you're putting this is always coming from capital gains. It's always capital gain related. It's not ordinary income. But if you had a lot of capital gain, you put it into the fund, which invests in the zone, the opportunity zone, typically in a building or something like that, or maybe even barren land. But you have to make improvements, and there's testing that goes with this.
Substantial improvements.
Exactly, substantial, exactly right. And there's testing to show that X amount of your resource, your assets are being put into that zone or that fund, that area. So there's a lot of testing that you're responsible for. So if you're a do-it-yourselfer, that's fine, but just know that you have to meet all and check these boxes off each year. It's reporting that you have to do. So often we'll recommend just go ahead and get it with a bigger group that's putting into it. Now, this came about in 2017 with the Tax Cut and Jobs Act. It had a lot of other incentives that you don't hear about right now because a lot of them phased out. They expired early on by, say, 2019 or something in that nature. However, the idea that you can defer your taxes, imagine if we go back to 2017, you had this capital gain, you want to defer it, you put it into one of these funds, and you wouldn't have to pay tax until the end of next year, December 31st, 2026. So it was really great then.
Just a
all that
deferral, though.
time.
It's not like it eliminates. It
Exactly.
just pushes it to the end of 26.
Good point. Excellent. Very important point there. So you're paying, and you never changed the character. So if it was a short-term capital gain back then, it's still going to be a short-term capital gain December 31st of 26. Would people still want to do this today? Well, we have used it as a tax plan. I've been in consults where, hey, you do have this option. It doesn't last long, but if they're in a situation they just need to get that capital gain off their return,
push it forward a
just
year
to
or
buy them
two.
one more year. If that's all they can get, that's great. And indeed, it will expire at the end of next year, and they'll have to pay the tax.
So why would I do it then?
If that's what, if you had a lot of tax, let's say you had 300,000
Sorry,
ordinary.
I was jumping ahead
Oh,
of the
yeah.
10-year part, but
Yeah.
let's finish that
yeah.
part.
No, that's a good point. So yeah, you're putting it up. If you invested in a building and then you pay your taxes at the end of 26, but Barley's pointing out here, well, okay, you still have this building. What if you sell it later on? What happens? If you hold on to it for 10 years, any additional gain, you don't pay any tax on. That's fantastic. If you get the right property and it takes off, it's really hard to beat. And Congress knows this as well, so there will be, we'll call it the Opportunity Zone Part 2, 2.0, that will be coming up in 2027.
Right.
And no, everyone asks me this, can I just roll over my previous one into the new? No. They're different rules, and they have some improvements on it.
Great question. Love the way you're thinking. The IRS just declined to.
Right, and Barley hit on a really important point. Is another aspect to this new plan that's coming out. They really do encourage new investment for the rural areas. Get some money out there to the areas that really don't have a lot of financing typically. So they really thought ahead on this and tried to take away some of the problems that were going on. Not that there was reported a lot of problems, but nonetheless they tried to refine the process. So we have a lot to look forward to in 27 with this. Strictly speaking today though, what do you got to do? You got to you have to have capital gains. You got to put it into a fund, a qualified opportunity zone fund, which is a partnership or a corporation. It invests in an opportunity zone, an area that has businesses or land that needs improved on or something of that nature. And then you will pay tax at the end of 2026 on that capital gains. If you hold on to that investment for 10 years, no tax.
Right, on the gain.
Yeah, lucky.
Absolutely. Yeah, so there's the qualified opportunity zone. That's just the political boundary, identifying the actual area, drawing a box around the area where we can actually invest. The fund, as Elliot said, is either going to be a corporation or a partnership. The fund is just the entity we use. What do we put the money in to go invest, right? What sort of taxable entity are we using? Again, partnership, S Corp, C Corp. So that's your fund, your opportunity zone fund, and within the greater opportunity zone. And yeah, the rural thing's cool because we have to. We're trying to build smart factories, and we can't refurbish a lot of these old factories.
Right.
We have to build new. So we're encouraging, massive dollar investment, massive capex investment in these kind of smart factories, essentially. We'll see if it all works, huh?
Yeah, technology is
see if it
really
all plays out.
making a difference.
Build those robots, Elon.
But it is really whether or not you want to do it yourself, take on all the responsibilities of the compliance, which there is. It's not like it's
That's probably the
small.
big one.
Yeah.
The tax part, we can help you with that,
Yeah.
but the compliance part that's what.
And that's on you as the do-it-yourselfer. You get to choose though the investment. Hey, I want building A, not building B. You
Right.
put it into a larger fund, you're not going to have. You won't be making those decisions, and you won't have that responsibility either. So it's kind of a toss-up. It just depends how You know, how much you want to be out there on your own on that.
Yeah, and whatever experience you guys have, if this is something you've done before, then go for it. If you're new to this, likely look to hop in on a group. You know, that would be the kind of basic starting point.
Or better yet, if you find out where a big group's investing, maybe
Absolutely.
$2 billion or something like it, well then buy the property next door.
Yeah, we're here in Las Vegas, obviously. I remember when they were building Allegiant Stadium and stuff. I just remember looking at these gas stations and hotels around and be like, man, those guys are so happy right now. They're just like, yes.
And then they just, especially if you just built. I know in my area where I built, they immediately had 2 car washes, a 7-Eleven type convenience store, all of them with that special bonus depreciation.
Right, all just came up overnight.
All this, again, just another example of where we started out earlier. The code is there to try and work our investment and enforce, incentivize, I think was our word.
Push us where we need to go, that's right.
And this is just another example of it.
I mean, a lot more we could go into there. Top items you should be thinking about, obviously the capital gains, the time period, and be careful with this. I mean, there is kind of like, it's not a 1031 exchange, but it has these similar kind of strict timelines and requirements. Just the compliance part is what we want to be focused on there.
Yeah, basically you got to get your capital gains within 6 months into a fund that you've incurred the capital gains, get it in there, and you do have a time limit to how fast you can invest in it, and 90% of the activity has to be, again, in that zone with that investment. So there are things that, and you have to do the paperwork behind that to make sure, the testing, as they call it. So it's something just to be aware of.
You know, and another thing worth mentioning is, so if you invest $100,000 capital gains, the substantial improvement requirement, you're going to have to come up with another 100 grand. So kind of just keep that on the back burner there. This isn't, if you only have the capital gains to reinvest, you'll have to have other sources of funds, right? I think it's 100% subsidiary, 80% or 100%.
You have to double the value.
Double the value. So if you buy a building or a car wash for 100, well, I guess that'd be more real estate. You have to improve the asset by 100%. So just throwing that out there. Well, it isn't just to defer the capital gains. You have to reinvest as well. Again, back to the point. That's what they want us to do.
Yep.
Take our cash, invest it for the long-term growth.
Yeah, definitely that 10-year thing is attractive, though.
Yeah.
I think that's what we got.
All right. Make sure you subscribe. I think we mentioned this a couple times.
Yeah.
Toby Mathis on YouTube. Hey, we're on YouTube Live right now, so you can go check it out. Subscribe to both of the channels. Tons of great guests. Guys, you can dig through the content on there. It's just really, really valuable. The interviews there with captains of industry and different leaders in the industry. A lot of great content there. And of course, scan this QR code right now to schedule a strategy session. If you really want to go into the weeds on taxes, we are ready. So scan this code, get more of an idea of what our services are. We'd love to have you become a client. And live events. This is something we focused on for a long time. Right? We had COVID kind of tapered off, but now we're coming back a little bit with the live events.
Doing more of the live events. We had really had a fine-tuned, well-oiled machine prior to COVID. We had teams, maybe 3 different teams, 4 different teams out there at any time on any weekend across the country.
Big production.
Incredible staff supporting it.
And
now we got them all. They're starting. We have 2 this weekend actually going on. We have the Dallas one, and we have another event. I want to say it's up in maybe Minneapolis area, something of that nature. It's cold wherever it is.
Right, up north.
Right, so take the parkas. But nonetheless, it's a great time getting, especially the Dallas one here. This is one of our own TAP events. Great chance to meet clients, to learn the stories, hear what they're doing. Oh yeah, you get in these conversations. Well, I did X, Y, and Z. Yeah, you don't want to do Z. Yep. That one didn't work so well. Here's our story. And a lot of that talking through things, and that's where you get some of your best advice out there.
I totally agree. I've heard it too. Overhearing conversations.
That is the best, is listening to you
really
guys talk about your investments.
Yeah.
I love this. I know it's hard to believe. I just shut up and just listen.
Yeah.
You know?
They'll just start going back and forth. Well, here's what I'm doing. Here's what I'm doing. Here's what I'm doing. It's great.
And I gotta say, that's one thing that's exciting. Whenever you hear Clint, Michael, and Toby start talking about business stuff like that, it is amazing. I just completely go silent and I just learn. I just go zen and a sponge.
That's right. Soak it all in.
It's all because of you guys.
That's right. And that is kind of the nice thing about Anderson. We're just applying what the partners are doing, what works for them. So it's kind of nice to know, right? This isn't just theory.
Yeah.
I have a degree in accounting theory.
Right, exactly.
Pretty useless, but where the rubber hits the road, that's where we like to be.
Exactly.
All right, let's keep it moving, huh? All right, how can I be exempt from paying the IRS the penalty of using my retirement money to buy my condo? So similar kind of line here. got some sort of retirement account. It could be an IRA, 401k, whatever. How do we get cash out of that if I want to buy a? I guess this could be a personal residence or a business
we're thinking
asset,
personal,
maybe. Yeah.
personal residence here.
Sure.
And this is just another provision where we start to look at the distinction between IRAs again and say your employer-sponsored plans like your 401k. This again is only for the IRA. I chose those two, the 72T in this question, not only because they're full of a lot of useful knowledge, but they show the difference between the different types of retirement plans and how the code can be kind of unfair, it may seem at first.
Very
IRAs,
different worlds.
it is,
Yeah.
it really is. And the IRA here again, you can take money out if it's for a personal residence and avoid penalty. Wow, okay. Can you do that? Can I do that with my 401k? No. Okay, well that's something that we need to be aware of, that there are different consequences to the type of retirement plan you have. It doesn't mean just go out and change your plan right now. You just want to be aware of it. But this is one provision for the IRA that you can take funds out. Now you are limited to 10,000. That's a lifetime exclusion. So you once you hit 10,000, you can't do it again. Interestingly enough, if you're married filing joint, or not, it doesn't have to be married filing joint, but if you're married, each spouse can take 10,000 out. So you can reapply, take 10,000 out. It can go towards down payment, building a new building, something like starting the construction or something like that. Anything like that towards getting your personal residence. So it's just kind of a thing that the government allows us to do to get us started. And again, they love to encourage real estate. We see that throughout the code. And this is just one element of doing that.
And you can do this every 2 years. It's for first-time home buyers, but every 2 years it kind of resets the clock. So you're back to being a first-time home buyer in 2 years. But yeah, I do like that option with each taxpayer and spouse if you're married filing joint. So that effectively doubles your limit there. That's great.
Now, we talk about, and this can go to acquisition costs as well, so anything like the closing again, things like that. But we talk about how an IRA can do this. Well, we got to thinking, well, my gosh, what are you going to do with if you have like a 401k? You have Anderson set me up with a sole 401k. What can I do? You do have a loan provision in your 401k.
Exactly, and which you can't do from the IRA.
Exactly. So they got back at him on that one.
Yep.
You can take out the $50,000 as a loan from your solo 401k. Now, you can do that with any 401k. The law allows it, but you got to go look to your plan itself, because your plan can be more restrictive than what the rules are, the code. So you want to check if you're working for Big Co USA, well then you want to make sure that their 401k allows for that, but the law does allow for taking a loan. Certainly your solo 401k, you're the one controlling that, so you can take your own loan up max to 50%. Is what you can take out of there. So that is something that one could do there, but that is a loan. You'd have to pay it back with interest. But at least if you needed it, you're allowed to use it for whatever you want when you take the loan.
Right. Good point.
Not limited just to your house.
Just a fun fact here, that first-time homebuyer credit, that can apply to a spouse's child, grandchild, ancestor. It doesn't have to be your primary residence. Just throwing it out there. This is maybe kind of common today, actually, when we have families moving in together, that kind of thing. So if that applies to you, you can take a look at that. We have some other exceptions here too.
We do. Just one other point I just want to point out. Well, what happens if I take this out? I'm in the IRA land again. I've taken this money out. My $10,000 is going to get my new home, or at least a down payment towards it. What happens if it falls through? You got 120 days, you got to get back in. Okay, so this is another thing, like anything that's got rules and dates and limitations, so you got to just be aware of that, make sure you get it back in time.
Can't just keep the money.
No, I mean, unless you wanted to pay the 10%
Pay the penalty.
penalty.
Yeah, right. This is all about avoiding the penalty, yeah.
Again, it's a taxable event. Taking out, you will pay tax on $10,000, you just don't have to pay the penalty, just to clarify on that. But yeah, there's a lot of other little nifty little details, and you're right, there was some exceptions. Did you see some of those there?
Yeah, so let's see. Eligible first-time home buyer, but that's kind of the obvious one, but we have this over 59 and a half. That's just our standard cutoff mark there. But also disability, distribution to after death, right? That's going to be included there. Certain medical expenses, health insurance.
I like that one right before that. Distribution is part of a series of substantial equal periodic payments. That sounds a lot like 72T. So
SEOSs?
Yes.
Or whatever it is.
I can't. SOSEPs, is that what it is?
SOSEPs, there we go, SOSEPs.
So,
we're going to have some more fun acronyms, guys, so stick around.
But that is the 72T they're referring to there. Just another example of ways to get money out of your IRA without paying that 10% penalty. So there is a little bit of flexibility there on things that will allow for this.
And just to reiterate, guys, I know we're just kind of reading off a sheet here. This stuff isn't on the slides, but we're talking about getting money out of your IRA. What are ways we can do that to avoid the penalty? So those are your topics there.
And 120-day limit, and again, $10,000 overall dollar limit. So there we have on that one.
And does not apply to the 401ks, 403bs, etc. All right. Any questions we got to hit there?
Oh yeah, they're filled up with questions on this stuff. No.
All right. No 72T questions?
Can't believe it. I was kind of expecting that to go off the charts.
Well, we do. You can look up 72T.
You have
-2F if you
have
want.
nothing else going on tonight?
Yeah, right. If you got trouble sleeping tonight, you can crack out the code book and see what's going on.
That's what these guys were talking about.
Well, should we keep it moving here?
Yes.
Let's see. We got a kind of a combined question here, 6 and 7. Do you have that combined together?
I do.
Great.
Yeah.
What's that one?
So this is going to be our expenses such as real estate, property taxes, and home improvements deductible on vacation homes used for both personal and rental purposes. I have been getting this question, right? Yeah. This has come out of nowhere. We've gotten this question a lot lately. I know the team has. We've talked about it in our meetings and go over this and over and over and over and over. There's a lot here, more than meets the eye. I guess just off the top, I would say, well, okay, you got a house. Can I deduct the real estate property taxes? Well, yeah, you can.
In most cases, personal or business, you can.
We talked a little bit about this. Where are you going to deduct that?
Well, if it's personal, Schedule A, if you itemize your deductions, right, as opposed to the standard deduction. Or if it's business, you just deduct on the rental, against rental income.
Right. But on the Schedule A, we do have that limitation, though, SALT limitation. Now, it is up to 40,000. That's nice, which can also, though, it phases out if you have over $500,000 of income. But nonetheless, you'll always get at least 10,000. And this would be part of that if you're paying county property taxes or something like that. So yes, we can deduct, and home improvements certainly, if they're on your personal residence, we don't get a deduction, but we get to increase your basis for when you later sell or something like that. Now, kind of flipping over on that, well, what if it's a rental? Well, you pointed it out, yeah, you can deduct the property taxes there as a rental. And then again, if you have improvements, well, it kind of depends. Is it a repair or is it actually an expense or an improvement? Repair being just that quick fix, something that brings it back to how it was without improving on it. It's not a betterment. Example, I break the stairs at the building I'm renting from Barley, and I go out there, I get a hammer or something like that, and I just put a couple nails into it or something like that, and just bring it back to how it was before I broke it. That's probably a repair. He can deduct that expense immediately this year. But now, second time I come in and I break it again, and boy, did I really do it this time. And I realized that there was a lot of wear and tear on it, and now it needs all kinds of boards in there to shore up these stairs. I'm putting a lot more effort into it, really not liking it. That's going to be more of an improvement. I'm making it better, stronger than it ever was before, perhaps, putting some improvement in it. Or adaptation, if you had a whole different use for a particular thing and you've changed it. Those are all things that are going to be capitalized. That means we got to depreciate it over time. And that's what we're looking at. So within this question, though, we have the situation where we have both worlds going on. It's a personal and it's rental. We have some other things that we got to be aware of there.
Right, absolutely. There's kind of a number of ways we could look at this. But yeah, so if we buy an asset for business use, let's say we're buying it to rent out, and we use it personally, it can affect how much deduction we can take. We do have some limitations here. If you use the business asset for less than 14 days or less than 10% of the total fair market days, whichever's less, right? Got to keep an eye on that one. As long as you're within that little sweet spot, you can deduct anything you want. You can take a loss, you can do a cost seg, you can take a big bonus depreciation, report a loss, all that. As soon as you go over more than 14 days or 10% of the total fair market value days, it's now considered a mixed use asset. It's part personal, part business, and you can't take a loss. You can deduct down to zero. You can deduct expenses, but if you're going for that big cost seg bonus depreciation deduction, you're not going to get that.
And if you're doing improvements, what I hear from our clients, I don't know about you, we hear a lot of heavy dollar amounts being put on some of these improvements.
Yeah.
And if you find out all of a sudden now Elliot, tells you that you're going to be limited in how much you can deduct, and maybe you can't take that big cost seg bonus depreciation, you're going to be angry with Elliot. It's not my fault. It's the rule. But now you talk, to Barley, and he tells you about this rule ahead of time. Well, you're able to plan for it, and do what you can to try and work with the rule. But when you get limited like that, again, you overuse it personally more than 14 days or the greater of over 14 days or 10% of the fair market rental days. Notice it's not the 365-day calendar. It's the number of days it was rented at fair market rates.
Right.
Any personal use goes to that 14.
Yep.
Any use by any related party, if you have family stay there, that counts as a
Even if you
personal
charge
day.
them rent?
Even if you charge them rent.
Wow.
Really kind of sounds kind of harsh. I get this a lot though, this question, and I know that the team does as well. But if you go over that, you're going to be limited. You do get to bifurcate. You get to separate out what expenses, what ratio of personal use for the property taxes, for the mortgage interest and things like that. You get to put that on your personal return.
Right.
Related to whatever rules are going on there. And then the business side, then you can take those deductions up to, again, the amount of rental income you have. So you do get to do that.
So property taxes, home improvements. Again, for your personal residence, if you put in a swimming pool or a new roof or something, you don't get a tax deduction in most cases, unless you're using your home for business or something like that. But just assuming it's just your regular primary residence, you don't get a tax deduction, but you keep those receipts, keep the invoices, those increase your basis. When you sell, that'll reduce how much tax you pay on the sale. Yeah, I think we covered that one pretty good, right? Personal and rental, we do get that question a lot. Certainly okay to use it. We like to say just don't use it personally, because that makes it so much easier. We don't have to worry about you guys and whether it's going to jeopardize these deductions, which can be a nasty surprise.
Yeah, and a lot of people do run into that surprise. I mean, and we say it all the time, I probably would use it though, personally.
Right, of course. But it's our
Admonish
job,
our clients
part
to
of
not
our
do-
job.
Right, exactly. We know what we're doing.
Of course you're going to use it. Got the spot on Manhattan Beach, go down to
Right?
the condo for a weekend.
There it is.
Come on.
Just don't tell Elliot.
That's right. Okay, what do we got next here? I'm attempting to calculate the reimbursement for administrative office. How do I calculate the reimbursement amount? Great call. So we're talking about a reimbursement here. So first of all, we're not talking about a deduction on Schedule C, right? We're getting paid back for expenses we've already incurred. Got a couple ways we can do this, right?
Yeah, it's a very special thing. Now, if you have something, a close cousin as I call it, a sole proprietorship or something like that, you have what's called the home office deduction. You got a method where you can just take the square footage of the room that you're using in your house, divide it by the total square footage, you get a percentage, take that times your expenses, your home expenses, and then you can take that as a deduction on your Schedule C on your personal return. But when we talk about administrative office, that's really something that's isolated towards when you're an employee. You are not an employee of your partnership, nor are you of your sole proprietorship. But if we're talking S corporation, C corporation, things of that nature, now we can do an accountable plan reimbursement for administrative office. And that is the same concept. We're taking that square footage. Now, I always like to use the example, let's say you have a 1,000 square foot home or apartment. You got that spare bedroom in the back that's 100 square feet. Right there, that's 10%, 100 divided by 1,000. So you could get reimbursed 10% of your costs. However, there is a provision where you can get rid of what we call the unusable areas, restrooms, hallways, stairwells. And in our example, let's say that's 200 square feet. So now we don't have 1,000, we have 800 square feet. So 100, we didn't touch the office, 100 divided by 800, that's gonna be 12.5, a little bit more there of our percentage. And then again, this is a reimbursement on what expenses?
Right. Most of your home utilities, if you own, it's going to be your property taxes, mortgage interest. If you rent, it'll be a portion of your rent. But gas, electric, cell phone, and internet, we can do it 100%. Just kind of keep that over on the side. But most any of your home utilities, HOA, security potentially.
What about outside? You know, you got gardening going on.
Right. That's kind of if you have like a home office where you see patients, maybe you have like a kind of more of a home business rather than a home office, that may be deductible. I mean, that's pretty much the gray area, right?
It
Do
is.
they allow that if we just have a home office?
You have to have continual people coming, and then the IRS says, okay, we can respect that. We understand why they have to pay extra to
beautify the entrance or whatever.
We understand this isn't Elliot's backyard with his dead plants. You know, these people are trying to make it look nice.
You don't want to see clients there.
No. A lot of death in my backyard.
Right. So if you have like a home daycare or something like that, you might be able to deduct a part of your landscaping.
Exactly. Now that's just one method. This, you're adding up, you're getting the tape measure out, getting all these dimensions and what have you. There's another one that you can use. First of all, the rule's bigger than all of this. It's any reasonable method. But the most common second method, number of rooms. Can you walk us through that? What's going on there?
So essentially the prerequisite to this is that you that all your rooms are relatively the same size. I don't know how strict they're going to be on that, but essentially, let's say we have a 6-room house, 4 bedrooms and a kitchen and a family room or something. We can say we're using one of the rooms, so 1 out of 6, whatever that percentage is, 27% or something like that, or less than that.
17, 18.
Thank you. Yeah, right. I'm not great with numbers now. So that if it turns out to be a more favorable rate to you, and it's still a reasonable method for calculation, we can certainly use that. That's the number of rooms calculation as opposed to the square footage calculation.
Yeah. So again, and you exclude again restrooms in that case. They're not rooms or anything like that. It's just, so that's you get your calculation, you get your percentage, ticket time, multiply it times all those expenses. But this is going to lead into something that we're going to talk about after this. We have a little bonus here for you today after question number 7. We got to make sure you get it paid. Okay,
Right.
If you don't pay, if your corporation doesn't pay you, remember it's reimbursement. They got to cut that check. You must receive, because you're both cash basis. Your cash basis. Well, you don't have to pay taxes on it, but your corporation is cash basis, so it's got to get that declared on its return, so it gets the deduction.
The deduction. Yep.
But it's tax-free to you, and it's a deduction to that corporation. So you want to do it before it's corporate year-end, which is typically often 12/31, but it doesn't have to be. If you had a March 31st year-end, that's fine. Just got to get that paid before March 31st, and that goes into some other things as well, which we're going to hit here in just a second.
Yeah, that if you want it on the tax return for that year, the expense has to be paid that year. So we just have to keep that in mind, cash basis taxpayer. And remember, you don't even have to report this as income, let alone pay tax on it. We have plenty of clear IRS guidance on this, using an accountable plan for reimbursements. If any of you have worked for a large employer, Fortune 500, most likely you've all gotten reimbursed for something. It's the exact same concept. This happens every day, all day. So it's not like, just to throw a twist in here, what we don't want to do is have the corporation pay our personal expenses. The corporation never makes our mortgage payment or our electric bill payment or anything like that. It reimburses us for a payment that we've already made. That's very, very important. And again, very, very common. We have lots of IRS guidance on this, and we can get great benefit from this. Cell phone, internet, you can add up your whole year's worth of cell phone and internet bills and reimburse yourself tax-free. Same with your home office and medical reimbursements through a C corporation. 280A meetings, meals, miles, travel, all that stuff can be reimbursed to you tax-free, and there's a benefit to it, right? It's like getting a little bit of cash back in your pocket.
Now, just back to the office real quick, a couple other points. I don't know if we said this, but it has to be an area that you use exclusively for the business and on a regular basis. Yeah, a couple of those. So I just want to point that out. Now, a unique thing happens when you do have that office. Before having the office, if you drove to your apartment, or let's say to your rental or something like that, you actually can't deduct that mileage. That's just a commute, and you're not allowed to deduct it. Now, once you get to the apartment and you have to drive to Home Depot to buy a new hammer and then come back, that mileage is deductible. But the actual deduction from your home to the rental and from the rental back home is not deductible. But once you have this administrative office, and it just has to be a primary place of business. You can have more than one. But once you have that, now any mileage, you're leaving the office, so now that mileage from your home to your rental, reimbursable to you, deductible to the business, we don't have that problem. I know physicians, they meet with a lot of clients or patients, throughout the day. They got to do their own homework, make their notes and things like that. I know many of them come back and do that from home. Or if you have employees and you don't really want to downgrade them in front of them in the office, you come back, you make your notes at home or something like that. You're working with your HR related questions at this one area that you use exclusively and regularly for that business. As long as you meet those criteria, then you're good to go.
I'm glad you brought that up, because a lot of you may have an office space that you rent, but come on, guys, let's admit it. You're entrepreneurs. You're working at home. We want you to get a credit for part of this. Why not have a portion of your living expenses, your utilities and such, paid back tax-free? It's a great option. Again, we're just trying to get you tax benefit for something you're likely already doing anyway.
Now, with all that said, I think we probably beat that one to death, but
Right.
we've got some other things. It's the end of the year, as we started out. So we got some things we just want to hit real quick, some last minute things, make sure we're doing them.
Yeah, so 12/31, unique. It's a year-end, calendar year-end, obviously, but there's certain things we want to focus on before year-end. Just printed out a couple kind of just to focus on here. We got payroll. Let's start
Absolutely.
there. That's an easy one.
Always run into it with the S corporation. You have to have that reasonable wage. So, but as we talked about, well, what if you have a sole 401k? Well, you got to get that payment in, okay? Because your contribution, the contribution by the employer, your corporation, that's all predicated on how much you get on your payroll check.
Right.
Got to get that payroll check out there. It's required if you're an S corporation, but even if you're a C corporation with a solo 401k, or if we're paying the children, we talked about that, or we have in the past, want to make sure you get paid. They got to get paid before year end.
Yeah, because you're, like Elliot just said, your retirement contributions are based on how much you paid yourself in the year. If you cut yourself a check after the year, that'll be for the next year. We're not looking at current period deductions anymore, right? It's very, very important there. We got bonus depreciation, obviously.
What's that?
You got to get the asset in service this year. I mean, you could place it in service next year and you'd still get 100% bonus, but if you want the deduction this year, we got to get it in service this year before the end of the year.
So you buy a heavy piece of equipment, or we always talk about real estate, but let's go equipment. You buy a heavy crane or something of that nature, purchase it, get it placed in service this year before 12/31. Now you can take 100% bonus depreciation. That's a big deduction.
But do I have to do the cost seg before the end of the year?
Well, on
I guess, yeah.
If it's on
Sorry,
equipment, you wouldn't
estate.
need to do a cost seg. We always talk real estate, so we're always thinking cost seg with bonus.
But what I wanted to throw in there, so if you purchase a piece of real estate before the end of the year, you'll get the tax deduction this year, but you have until tax filing to do the cost seg study to get that implemented. I wouldn't wait till the last minute, but you have essentially till next October. You get a short-term rental, get it into service this year. We don't need to file that cost seg study report until the next tax filing. It's going to be based on when it was placed into service, the amount of bonus depreciation, which isn't as important anymore because we have 100% this year, 100% next year. We're not too worried about that part. But if we want the deduction this year, we got to get the asset in service.
Just was talking to a client today. This is a common thing this time of the year. What if I get a vehicle? Now, yes, bonus depreciation's back. However, when it talks about vehicles, it's a little more stingy than that. The vehicle, typically the client's going to get where they get 100% bonus depreciation, it's going to be the over 6,000 pounds, and it's got to be an SUV. It could be a truck, okay, a heavy truck. But usually what we're seeing clients get is the SUV, but it's got to be over 6,000 pounds. That means that your sedan, your car, even if it's over 6,000 pounds, that's without Elliot in it, even if it's over 6,000 pounds, you're not going to be able to take 100% bonus depreciation on the whole vehicle. You still have to, you're going to have some limits, okay?
I was like, what car? I guess maybe a Bentley weighs probably
Yeah,
over 6,000 or something.
they look really, those doors are...
Doors are probably a couple of hundred pounds each.
Yeah, right, exactly. It's almost, just the doors themselves are almost 6,000 pounds. But case in point, you get that heavy SUV, now it qualifies for 100% bonus. And we've talked about this before, you can do the 179 deduction, which is immediate expensing and some bonus. That's another tax tool we have, but whatever it be, you got to have that vehicle, have it placed in service before year end. And if you want the heavy deductions, it's got to be over 6,000 pounds SUV or heavy duty truck, things of that nature.
Yeah. What else? Yeah, so bonus is back. That's obviously the big news for 2025, 100% bonus continuing into 2024. So related to payment, we want to set up any retirement contributions. What's our timeline? Oh, yeah, I see this. We see people mess this up every year, unfortunately. So let's touch on this now.
The employee has to be paid before December 31st. The employee, individual, human, is on a calendar, tax year January 1st to December 31st. That's why it's so critical that your corporation get that paid. If it's a C Corp, your C Corp may have a different tax year end, and that has its own benefits for tax planning. However, the employee's got to get paid before December 31st. Make sure you have that happen. The employer can wait until it has its return due. It doesn't have to have it before December 31st, unless that happened to be when its return's due.
Right. So that employee-employer difference, that is kind of confusing, but that's the only staggered timeline part of this. The employee kind of has that cutoff at 12/31, and we're still talking about these contribution limits, guys. 70,000 or more, depending on your age. I mean, you got to pay yourself quite a paycheck to hit that limit, but I mean, 70,000 to each you and spouse every year over to a solo 401k that we can then invest in real estate, stocks, etc. All that growth is tax-free. We can borrow from that plan. A lot of flexibility there for Just to remind you guys, most of our clients are closely held, family-held corporations. This is nothing but benefit here. This is a very, very powerful tool. So massive contribution limits. Make sure you pay attention to that before the end of the year. It's based on your salary. So if you need, if you want to pay yourself a little more into the solo 401k, you can give yourself a little bonus at the end of the year. Pay yourself a little less, you'll pay less payroll and taxes.
And this year, we do have that little bit of a difference on how much more we can pay. If you're under 50, it's $23,500. If you're over 50, we have this catch-up of an additional $7,500. And then we have this weird kind of, what if you're between 60 and 63, right? It goes up to $11,250.
But then when you turn 63, then it's off.
It's kind of odd, and I don't know where in the world they picked up those numbers, but that's what it is. So if we're over 50 but under 60 and not yet and over 63, you just have this carve out between 60 and 63 where you get to put in an extra $11,250 as opposed to just the $700.
But if you look at this again, incentivization, the government's just like, hey, if you're 60 years old and haven't stacked for retirement and you're making money, here, you can do this now. Put an extra $11,000 on top of the 70 plus the $7,750. So that's a huge amount of cash.
Yeah, incentive. That is the big word of the day.
Right.
You can see it all over the code.
Yeah, we like to think that we think for ourselves, but we really don't. We just go wherever we're steered. Go this way. What else? Augusta rule, home office. A lot of these kinds of things are in the same boat. We got to get these turned in so we can get a reimbursement. Medical,
on the C Corp?
Absolutely, through C Corp, huge one. Because what we want at the end is this check that we don't have to report or pay taxes on, right? To substantiate that, we actually have to have the corporation make a cash transaction, ACH, Zelle, whatever. It doesn't have to be a check or cash, obviously. The money has to change hands, right? To do that, you just got to submit a copy of your invoice or whatever to the C Corp to reimburse yourself. But yeah, medical, the Augusta rule, home office, cell phone, internet, all these things. Again, if we have a different C Corp calendar year in March, that won't apply. But assuming just a calendar year end for your C Corp, we want to have these reimbursements in by the year end so we can get paid back before the year end so we can get the deduction on our tax return in that same year.
That's a plan.
Last one, kind of this charitable giving, the bunching trick. When you get to the end of the tax year, if you're just under that itemized deduction rule, and you expect to itemize in the following year, you could double up your charitable donations in the following year if that's important to you to get the tax deduction for that. Remember, if you're making charitable donations but you're not itemizing your deductions, you're kind of not really getting any tax credit for that. If that's important to you, you could just double it up in the next year. That might push you over the standard deduction limit. You get a higher deduction. That's
certainly correct. Just one thing there that we might want to think about, though. We might want to double up this year if we can. Get it this year as the deduction, because next year they introduced a small floor that we're going to have, that 0.5% floor in our charitable giving.
That's right.
2026.
26.
It's not the worst, 0.5%, but if we're giving substantial amounts,
if you're giving $100,000, that's something.
Might mean a bit much more.
Right.
So just keep that in the back. But absolutely, the bunching is a great idea if we need to get into that.
That was all I had. I mean, there's plenty more stuff for year end. I just kind of wanted mainly just to make sure we're all thinking that way, right? You're going to hear Elliot and I say this, Amanda say, all your advisors here say, a lot of stuff we got to look at before the end of the year. So mainly just want you guys to start kind of forming that mental checklist. Don't let the calendar beat you, right? Run payroll, solo 401k, get those padded out this year, get the deductions this year.
And again, just want to thank our team so much. We got, again, Troy running the chat. We got Dana, we got Dutch, Jared, Jeffrey, Rachel, all out there answering questions. Yeah, we got the road warrior, Zion, in the back there.
Right. Barely hanging in there. Zion's been traveling, doing film work.
Yep.
Our camera guy in the back.
Can't stop the guy.
Yep. Well, thanks again so much for joining us. Kept you, well, we only went an hour. We didn't go too bad here. Make sure you hop on YouTube. You're already there, but make sure you go subscribe to the channels. Come check out the live events. We really do love seeing you guys there. It's so fun when I get to meet you guys, or Ellie gets to meet you guys, then we can talk about your business on the phone. It just adds a whole nother kind of layer of depth to our relationship. Yeah, we're all in this together, man. We got to do it together. Scan this QR code right now. Set up a strategy session. You can do this right now. Get on the phone with one of us. If you got questions about this end of the year stuff or any of these, the 72T,
yep.
whatever we went over, let us know. We're always happy to hear from you. We really, this is kind of our passion, helping you entrepreneurs do your thing. And join us again in 2 weeks.
Yeah,
Right.
we look through all the questions. So get them into Tax Tuesday at AndersonAdvisors.com. Visit us at the website, AndersonAdvisors.com. Got all kinds of events listed there, all kinds of information.
Yep. Good work today, guys.
Yeah.
Good work. So any other questions remaining? If we aren't getting your questions here, if you are a Platinum client here, you can, of course, submit those to the Platinum portal 24 hours a day, or hop in the live Platinum Knowledge Room 5 days a week, 5 hours a day, staffed by attorneys and CPAs and tax preparers all day long. So come in there and ask any questions you have, and we definitely look forward to seeing you next Tuesday back for Tax Tuesday.
Thank you.
Thanks, team. See you next time.